Hello, and welcome back to Boni's Life, the only channel where we navigate the chaotic, exhilarating, and sometimes downright terrifying world of cryptocurrency with a cool head and a plan. If you've taken a peek at your portfolio in the last couple of weeks, you might have felt a sensation similar to riding a roller coaster, blindfolded. 1 minute, you're soaring to all-time highs. The next, you're plunging into what feels like a bottomless abyss. Just recently, the market witnessed the single largest liquidation event in its history. Over $19 billion wiped from leverage positions in 24 hours. That's not just a dip, that's a seismic event, a great reset. But here's the thing about resets. They create opportunity. While the headlines scream crash and the fear and greed index cowers in a corner, the smart money is recalibrating. They're not panicking, they're preparing. And that's exactly what we're going to do today. We're going to cut through the noise, dissect the data, and build a concrete, intelligent framework for trading this market. Whether you're a short-term scalper, a mid-term swing trader, or a long-term hodler with hands of diamond, we'll dive deep into the key market indicators: volume, total market cap, the infamous fear and greed index, open interest, and those brutal liquidations. We'll connect the dots between the crypto charts and the global economic stage, looking at how events like the Federal Reserve's next move could send shockwaves through the market. And most importantly, we'll cap it all off with actionable strategies and technical setups to help you not just survive but thrive in the weeks and months ahead. So grab your coffee, silence the FUD, and let's get to work. To understand where we're going, we first have to understand where we are. And right now, we're standing in the aftermath of a classic crypto narrative, a tale of two very different Octobers. The month started with unbridled euphoria. Bitcoin shattered its previous records, blasting past $125,000. The total crypto market capitalization crossed the monumental $4 trillion threshold for the first time ever. It felt like the party would never end. Pundits were calling for $150 worth of Bitcoin by Christmas, and the market sentiment was pure, unadulterated greed. And then, between October 6th and October 10th, the music stopped. In the span of just a few days, Bitcoin tumbled from over $126,000 to nearly $105,000. As I write this, we're consolidating around the $108,000 mark, with the market having bled for 7 straight days. This isn't just a garden variety pullback. This was a violent deleveraging, a flushing out of a speculative excess that was long overdue. But does it mean the bull run is over? Is it time to run for the hills? Not so fast. Leading institutional voices like the analysts at Van Eck are framing this not as the start of a new bear market, but as a mid-cycle correction. This is a crucial distinction. A bear market is a fundamental long-term shift in trend. A mid-cycle correction is a healthy, necessary reset that shakes out the over-leveraged tourists and allows the market to build a stronger foundation for its next leg up. The structure of the market, which we'll dissect, supports this view. To get a real-time pulse of the market's emotional state, we turn to the crypto fear and greed index. Think of it as a market psychiatrist. In early October, it was screaming extreme greed. Today, it's whispering fear, with the reading hovering around 27. Just a week ago, it plunged to 22. A level of extreme fear not seen since last April. Now, for the contrarian investor, fear is a beautiful thing. The legendary investor Warren Buffett famously advised to be fearful when others are greedy and greedy when others are fearful. While the herd is selling in a panic, the professional is calmly looking for entry points. This prolonged state of fear suggests market exhaustion, where the selling pressure is starting to run out of steam. It's the market taking a deep breath before its next major move. So what exactly happened on October 10th? What triggered the single biggest liquidation cascade in crypto history? The answer lies in one word: leverage. In crypto, leverage is like rocket fuel. It can propel your profits to the moon. But if something goes wrong, it can blow up on the launch pad. Traders, especially on offshore and decentralized exchanges, were borrowing massive amounts of money to place hyper-leverage bets on the market, continuing its upward trajectory. We're talking about exchanges offering 100 times, 500 times, and in one case, a mind-boggling 1001 times leverage. It's financial insanity. To put that in perspective, 100 times leverage means a mere 1% move against your position is enough to wipe out your entire capital. With 1000 times leverage, a 0.1% move liquidates you. It's not trading. It's gambling on a coin flip with a guillotine hanging over your neck. Before the crash, Bitcoin futures open interest, the total value of all outstanding futures contracts, had swelled to a peak of $52 billion. The system was saturated with leverage. Then came the trigger, a whiff of geopolitical uncertainty, with renewed US-China trade tensions. This caused an initial price dip, but in a hyper-leveraged market, a small dip can trigger a catastrophic chain reaction, what some call a doom loop. The initial dip forced the first wave of liquidations. These forced sales created more selling pressure, pushing the price down further. This, in turn, triggered the next wave of liquidations. The exchange's algorithms automatically closed position after position as traders' collateral evaporated. It's a snowball effect, and it was amplified by thin order books. There simply weren't enough buyers to absorb the flood of sell orders, causing prices to crater. Bitcoin fell 20% in just 8 hours, but the real carnage was in the altcoin market. While Bitcoin and Ethereum are somewhat insulated by their size and institutional backing, smaller, less liquid tokens saw their values plummet by 60%, 70%, or even 80% in a matter of hours. However, there's a silver lining to this $19 billion bloodbath. This massive flush has reset the market, the speculative froth has been blown off, open interest has fallen by 25%, and leverage ratios have normalized from the 95th percentile down to a much more sustainable 61st percentile. This is a much healthier foundation to build upon. Interestingly, this event has also highlighted a maturing of the market. For the first time, the open interest in Bitcoin options, which is often used for more sophisticated hedging strategies by institutional players, has surpassed futures open interest by a staggering $40 billion. This indicates a significant shift. The smart money is increasingly using regulated venues like the Chicago Mercantile Exchange, CME, and more complex derivatives to manage risk, a sign that the industry is slowly but surely growing up. No market is an island, and crypto is more intertwined with the global financial system than ever before. To truly understand its trajectory, you have to look beyond the charts and analyze the macroeconomic forces at play. And right now, the most important player on the board is the US Federal Reserve. After a period of tightening, the Fed is now widely expected to cut interest rates at its upcoming meeting at the end of October, likely by 0.25 percentage point. This would be the second cut this year, signaling a definitive pivot towards a more accommodative monetary policy. Why does this matter for Bitcoin? Because Bitcoin's core value proposition is as a hedge against currency debasement. It's often called digital gold for a reason. When the central banks print more money and lower interest rates, the value of fiat currencies like the US dollar erodes. In that environment, scarce assets with a fixed supply like Bitcoin become incredibly attractive, and we can see this relationship in the data. Over the last decade, Bitcoin's price has shown a significant correlation with the growth of global M2 money supply, a broad measure of the total amount of currency in circulation. As global liquidity has doubled from $50 trillion to nearly $100 trillion since 2013, Bitcoin has responded. A multivariable regression shows that changes in the money supply of the top 5 fiat currencies can explain more than half of Bitcoin's price variance over the past 10 years. So as the Fed prepares to turn on the money printer again, it's providing a powerful tailwind for Bitcoin's long-term valuation. Another fascinating shift is in the geographic distribution of price discovery. For years, the US and European markets led the way, but recently the momentum has shifted east. Data shows that Asian trading hours are now leading global Bitcoin returns, both on the way up and on the way down. This suggests that regional liquidity dynamics, particularly the tightening of monetary policy in countries like China and India as they defend their currencies, are having a direct and immediate impact on the crypto markets. This globalization of the market adds another layer of complexity, but also reinforces Bitcoin's role as a neutral global reserve asset. Finally, the political landscape in the US is also a factor. The current administration has adopted a more pro-crypto stance since the last election, which has fostered a more favorable regulatory environment. While there is still gridlock in the Senate over a comprehensive market structure bill, the general trend is towards regulatory clarity, which is crucial for attracting long-term institutional investment. All right, we've covered the what and the why. Now, let's get to the how. How do we trade this market? The right strategy depends entirely on your time horizon. A plan for a day trader is useless for a long-term investor and vice versa. So let's break it down. For the short-term trader, the scalper, your world revolves around the hourly and 4-hour charts. You live and die by volume, momentum, and key intraday levels. Right now, the battlefield is clearly defined. We have a dense wall of resistance around the $111,000 level. This is a major liquidation cluster, meaning a lot of traders who are currently underwater will have their positions forcibly closed if the price hits that mark. A decisive break above this level could trigger a short squeeze, where traders betting on a price drop are forced to buy back in, adding fuel to the rally. On the downside, we have critical support at $106,600. This is the line in the sand for the bulls. If it breaks, the next logical targets are the recent October lows around $103,700 and the major psychological barrier of $100,000. Your strategy here is to trade the range. Look for opportunities to buy near support and sell near resistance using indicators like the relative strength index, RSI, to spot overbought or oversold conditions. Always use a tight stop loss because in this volatile environment, the trend is not your friend, it's a fickle acquaintance who might leave you at any moment. For the mid-term trader, the swing trader, you're looking at the daily and weekly charts, trying to catch the larger swings in the market that last for several days or weeks. For you, this mid-cycle correction is a gift. You're not chasing the noise, you're looking for the signal that the next major wave is beginning. The setup to watch for is a potential double bottom pattern, where the price tests the recent lows around $105,000 and then bounces strongly, confirming that the bottom is in. Your trigger isn't just a price move, it's a shift in sentiment. You'll be watching for the fear and greed index to climb back out of the fear zone and into neutral, a reading above 40. This would indicate that confidence is returning to the market. You're also looking for confirmation from the upcoming Fed meeting. A confirmed rate cut could be the catalyst that ignites the next rally. Your strategy is one of patient accumulation. You're not trying to catch the exact bottom, but rather buying into strength as the new uptrend confirms itself. Your targets are a retest of the $115,000 to $120,000 range and eventually the previous all-time highs. For the long-term trader, the hodler, you're playing a different game entirely. You're not a trader, you're an investor. The daily price fluctuations are just noise to you. Your time frame is measured in months and years, and your analysis is rooted in the fundamental long-term value proposition of the asset class. You're looking at the monthly charts and, more importantly, at the macroeconomic data we discussed earlier. Your primary indicator is the global M2 money supply. You see the impending Fed rate cuts not as a short-term catalyst, but as another step in the inevitable debasement of fiat currency, which strengthens the case for Bitcoin as a long-term store of value. You're also watching on-chain metrics, like the percentage of Bitcoin supply that hasn't moved in over 3 years, currently a staggering 43%, which shows the powerful conviction of long-term holders. Your strategy is the simplest and historically the most effective dollar cost averaging, DCA. You're not trying to time the market, you're systematically buying a fixed amount at regular intervals, especially during periods of extreme fear like the one we're in now. You're accumulating an asset you believe in for the long haul, with your eyes on the long-term price targets of $150,000 or even the $250,000 predicted by bulls like Mike Novogratz. No matter which type of trader you are, a strategy is worthless without discipline and robust risk management. The crypto market is designed to separate emotional traders from their money. It preys on greed and fear. The only way to win is to have a plan and stick to it. First, position sizing. Never risk more than you are willing to lose on a single trade. A common rule of thumb is to risk no more than 1 to 2% of your total trading capital on any given position. This ensures that a string of losses won't wipe you out. Second, stop losses. If you are a short or mid-term trader, the stop loss is your best friend. It's your automatic ejection seat that gets you out of a bad trade before it becomes a catastrophic one. Decide your exit point before you even enter the trade and honor it. No exceptions. Third, beware of leverage. As we saw from the October crash, leverage is a double-edged sword with a very sharp blade. If you're a beginner, my advice is simple. Don't use it. Learn to trade profitably with your own capital first. For experienced traders, use it sparingly and with extreme caution. The allure of massive gains is strong, but the reality of massive losses is devastating. Finally, diversification. Don't put all your eggs in one basket, not even in the crypto basket. And within your crypto portfolio, consider diversifying beyond just Bitcoin and Ethereum. Explore promising Layer 1 protocols, DeFi projects, and other sectors of the digital asset economy. But do your own research. Don't just chase the latest shiny object being shilled on social media. Trading is a marathon, not a sprint. It's a game of probabilities, not certainties. There will be winning trades and losing trades. The key is to ensure your winners are bigger than your losers over the long run. It requires patience, discipline, and the emotional fortitude to stay calm when everyone else is panicking. It's about having a plan and having the conviction to execute it. So there you have it. The great crypto reset of October 2025 wasn't the end of the bull market, but a violent and necessary cleansing. It flushed out the reckless speculation and has created a much healthier foundation for the next leg up. We've seen that for the short-term trader, there are clear ranges to play. For the mid-term trader, this correction presents a prime buying opportunity as we await the next catalyst. And for the long-term investor, the fundamental bull case, driven by global monetary policy, remains stronger than ever. This is a market in transition. It's maturing, with institutions playing an ever larger role. But it's also still the Wild West in many ways, with volatility and risk around every corner. The key to success is to know what game you're playing, to have a strategy tailored to your own goals and risk tolerance, and to execute that strategy with unwavering discipline. What are your thoughts? What's your strategy for navigating this market? Let me know in the comments below. I read every single one. And if you found this analysis valuable, do me a favor and hit that like button and subscribe to the channel. It tells the YouTube algorithm that we're doing something right here, and it helps us bring this content to more people. Stay smart, stay safe, and I'll see you in the next episode of Boni's Life.